Angel financing, understanding angel investment and the angel's business model. The term angel investor derives from the individuals responsible for financing theatrical productions. The movie and Broadway musical The Producers presents a story involving angel investors and the financing of stage shows. In The Producers, the financially unsophisticated elderly investors are stripped of their cash through fraudulent misrepresentation by unscrupulous but hilarious entrepreneurs. As a result of such fraud and misrepresentation in the past, US federal laws were enacted to protect unsophisticated investors. Angel investors financing startup ventures must now have accredited investor status in the United States. An accredited investor is considered sufficiently financially sophisticated to back a startup venture and must have a net worth in excess of $1 million or earnings of more than $200,000 a year. Following the dot-com crash, there were severe down rounds known as Cram downs, where the angel investors lost their rights in the new low-priced refinancings. This disappointed many angel investors, and they switched into other forms of investment such as real estate. Depending on the state of the housing market and the technology sector, angels often switch between real estate and startup financing. Although many angels have seen their startup investments fail, and they're often referred to as family, friends and fools, angels are an important and growing source of financing for startup ventures. Angel investors can do much more than provide seed investment. They can join the team, often by taking a seat on the board of directors or the board of advisors. Angels are very useful at making introductions. Introductions to other angels, venture investors, potential customers, professional service providers and others. Angels are often experienced in business and provide guidance to the entrepreneur and managers. Angel investors with experience and impressive track records can add credibility to the team, providing grey hairs and adult supervision. Like venture capital investors, angels follow the principles of the modern portfolio theory. They diversify their investments to mitigate the risk of any one investment failing to perform. The laws of probability would mandate that several investments may fail, but several are likely to succeed. Participation in angel syndicates is an effective method of spreading the risk across numerous investments. In the angel syndicates, often one angel leads the round, setting the financing arrangement with the entrepreneur, while the other angels follow, investing on the same terms. Like venture investors, angels collect together in groups and they flock. When an angel backs a company, others will usually follow. Word of mouth spreads quickly through the angel community. Sometimes the angels combine their funds into a single investment. Other times they each show up as separate investors on the company capitalization table. Some angels aspire to be venture investors, and several angel groups have organized and developed into VC funds. The traditional Silicon Valley instrument for a seed stage angel investment is a note, a loan that acts as a bridge to a subsequent venture capital round of funding. The note converts to preferred stock when the subsequent round of funding is closed with a venture investor. To reflect the high risk involved in financing the company before it has venture backing, the note carries a discount, so the angel investor may have, say, 15% discount on the price paid by the venture capital investor. The other way of looking at it is the 15% discount is that the angels get a 15% more of the preferred stock for their dollars than the later to arrive venture investors. An advantage of this bridge convertible note structure is that it's acceptable to the venture investors. Venture investors are generally not scared away from the company because the angel investors invest on substantially the same terms as the VC. The advantage for the angel is that they get the same preferred rights as the venture investor. The angels are not stuck with common stock. There are disadvantages with this structure, most notably when the company proves unsuitable for venture capital funding and the bridge becomes a bridge to nowhere. If the company does not reach exit via a merger, acquisition or IPO, the angel will be unable to liquidate the investment unless redemption rights were negotiated as terms of the note, in which case the angel can ask the company to repay the loan, usually with interest. From the entrepreneur's perspective, there is a difference between the duties owed to a shareholder and those owed to a creditor. With a note, the angel's relationship with the company is as creditor. But when the note is converted to stock, the angel becomes a shareholder. Shareholder rights attach, and the company has enhanced duties to provide information and voting rights to the shareholders. Up until recently, angel term sheets contained a multitude of protections and provisions. This meant the term sheets were complex and difficult to negotiate with entrepreneurs. Then when the venture investors came in with a preferred stock round of financing, the terms that had been negotiated by the angel investors were washed out. Venture capital investors often ensured that terms of angel financing were rendered void as a prerequisite before the venture round closed. The current trend for many angels is to offer entrepreneurs a much simpler term sheet, referred to as term sheet light. These simple term sheets usually protect the angel's interests by providing the angel with the right to convert to preferred stock on the same terms as the later venture investor. Angels offering term sheet light arrangements find the negotiation process with entrepreneurs is much simplified. Their interests are aligned with the venture investors, and the venture investors can't exactly complain if the angels benefit from identical terms as they have themselves. Another alternative to the traditional investment structure is a startup bond. This is a note with an option to convert to stock at a subsequent VC round, a merger and acquisition, or IPO. The note holder also holds a right to redeem, to put the note to the company for repayment with interest after the company's become established. The advantage of this form of note is that conversion is not dependent on venture capital financing. Also, the angel gets to exit with profit if the company succeeds but is not sold or achieves IPO. From the entrepreneur's perspective, this structure does not require the company to issue preferred stock, so the founders give up little or no management control. The investor remains a creditor and shareholder rights do not attach. The disadvantage is that this type of note is new and relatively unfamiliar to angels and their attorneys.